Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, a network of family offices based in Greenwich, Connecticut. Circulus will be hosting its next Family Office Summit on May 15th in New York for 75 family offices, and will feature Jim Tannenbaum, founder of Foresight Capital and previous guest on this show, as well as Roger Ferguson, former vice chairman of the Federal Reserve, in conversation with Rebecca Patterson, who is also a former guest on this podcast. If you are a part of a family office, you can apply to attend at circulus.substack.com. Today we are going to hear the story of one of the most interesting firms to spring from a significant family office. JB and Tony Pritzker approached today's guest, Paul Carbone, with the idea of expanding their direct investments into a freestanding firm called Pritzker Private Capital. Paul takes us through that journey, and we discuss the importance of a well-defined value system, the benefits of family capital, partnering with other families, the difference between flexible and patient capital, the problem with club deals, and why direct investing is not for everyone. Paul Carbone is co-founder and vice chairman of Pritzker Private Capital. In 2012, Paul joined Pritzker Private Capital's predecessor company and led the firm's growth and development for more than 10 years. Prior to Pritzker, Paul was the director and managing partner of Robert W. Baird & Co.'s private equity group after serving as co-director of investment banking responsible for mergers and acquisitions. Previously, Paul was senior vice president in the investment banking group at Peabody. Paul received his MBA from Harvard Business School and his BA, Phi Beta Kappa, from the University of Chicago. Please enjoy my conversation with Paul Carbone.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
I always like to start with asking folks a little bit about their background.
Sure. I was born and raised in D.C. and then outside of D.C. Until high school. Moved to the Midwest when my father took a job running the University of Wisconsin Cancer Center in Madison. So I did a couple of years of high school there, and then in love with economics and a fellow named Milton Friedman, and found out that he and his colleagues were at the University of Chicago. And though I had my older brothers and sisters went to Amherst and Harvard, I wanted to go to University of Chicago. Because as a young man, I always was interested in stocks and investing in companies. And I knew from a young age I wanted to be involved with the corporate world. And again, my family's mostly MDs. And so I was the black sheep, the first one not to be an MD. And I'm one of 7 in my family. University of Chicago, met my wife, my future wife, and studied economics. Got a job on Wall Street during college because I knew I wanted to be transactional as opposed to a consulting path. I wanted to do deals. This is a young man talking. I wanted to do deals. And I wanted to learn about how you evaluate companies, how you look at the financial statements, et cetera. And I thought that investment banking was going to allow me to see lots of industries, lots of companies, and then give me the tools and the toolkit to look at companies from perspective. And so I wrote all the investment banks on Wall Street and said, I want a summer job. The only one that even listened to me was Peabody. And they said, we got a job in the research department, except it's in the mailroom. So you can come in and deliver mail. And I said, done. So I came in my junior year. I delivered mail, and then I had taken some computer courses. And this is at the early onset of the use of computers. And so I convinced them that I could help them analyze their stocks more efficiently than doing it on a spreadsheet by hand using computers. And so I could program a computer. So I helped the retail analyst evaluate his stocks so he could be quickly evaluate his stocks every day and put out his notes faster. So I did that for the retail analyst. And I did that for a while, and then I got bored. So I said, I've heard about this thing called corporate finance over on the other side of the house. I'd like to learn more about that. And so they let me go over there, and I got into corporate finance. And this is across 2 summers. And then I joined Kidder after I graduated from college. And they said, we've got an idea for you. We want you to go to Chicago. I said, the mecca of finance is New York. Why are you shunting me to the hinterland? 1, you're from Chicago, and two is they need help. They've got a computer. It's in their closet, and no one knows how to use it. So they said, go out and help them figure out how to use the computer. And I did that. So I launched a career at Kidder, terrific firm, terrific partnership, learned a lot, great people. And I went to business school after a couple of years at Kidder in the analyst program. At business school, learned a lot, loved Harvard, but went back to Kidder. And by then, Kidder had multiple self-inflicted wounds and was headed the wrong direction. I was at Kidder in total about 9 years, but 3 of us decided that Kidder was not going to survive. And we basically said, let's team up and do something together. And we had 2 options. Ultimately, we had 2 options. We could set up the Dillon Reed office in Chicago or go work for this small investment bank in Milwaukee that was more of a brokerage firm than an investment bank. And we decided let's go for the more entrepreneurial path. So the 3 of us joined Robert W. Baird in Milwaukee. I think it was about $160 million revenue business, mostly brokerage. But I came in to help them build their M&A department, but that was on a path that allowed me to take over their private equity group, their investing business. But they said you had to build the M&A business first, and maybe you could wear 2 hats and then eventually take over the investing business. And then my other colleagues eventually would run investment banking and then run the firm. So we did that. It was a culture shock. I talked to one of my big clients I'd done a lot of M&A for, and I told him I was moving to Baird, and he was silent. This is a big corporate client. I did a lot of buy-side M&A for him, and he was silent. And he said, Paul, Baird doesn't have an M&A department. And so he gave me a little pause, and he was right. And so we built an M&A department, but my goal was to get into the investing business as a principal. And they had 3 people basically investing off the balance sheet and opportunistic opportunities, 30 million, something like that. They let me run the M&A department, but also oversee the principal investing operation. And over time, we built that business to when I left, we had 55 companies that we had invested in. We were operating in US, Europe, and Asia. We had launched a venture fund. We were doing small cap buyout, growth equity. And I think we'd built something pretty special. But it was challenging within an institution to execute this investing business because one is the regulatory overlay, but you've got extra layer of regulatory constraints because you're operating within a regulated entity beyond the regulation of the investing business. 2 is you had to operate within a larger institution. So constraints about what you could and couldn't do. Outside of third-party investors, during this period when I was at Baird, we started taking outside capital. And so taking outside capital into an affiliate institution has always been challenging. People are sensitive about committing capital to a unit within a larger institution. So multiple reasons. And you had the constraints of a traditional private equity firm, time-bounded. You were selling your winners first. You built companies in different ways because of the constraints of the business model. And I'd seen something called family capital. I'd gotten to know a number of families in the area, and I was watching how they invested. And they were investing in a fundamentally different way. They had the flexibility to make the right decisions at the right time for the right reason and for the right duration. They were unconstrained in multiple ways where I was constrained working in an institutional shop. I was intrigued by family capital and the opportunity to build companies what I consider to be the right way for the right duration. And lo and behold, the Pritzkers saw what I was doing at Baird, and they knocked on my door. And they said, we want to build, this is JB and Tony Pritzker. They're 2 of the 11 third-generation Pritzkers. And the family had decided to sell the jointly held assets in 2001. The capital was distributed down to the third generation in a 10-year liquidity plan. And they reached out to me basically in 2011 and said, we want to build up our direct business. They had 3 businesses at the time. They had a small direct middle market business where they were buying smaller companies. They had a direct venture business and then an asset management business. The asset management business was managing the liquid capital, creating diversification, but was effectively the piggy bank for the 2 other direct businesses, direct venture, direct buyout. And they wanted to build and scale their direct buyout business commensurate with the capital that they now had at their disposal. So they knocked on my door and said, we've seen what you've built at Baird. We'd like you to build that here. And I said, no. I'd been at Baird 17 years. I was on the executive committee. We had done a lot of exciting things in the private equity venture business, but also as an institution at Baird. But over time, I evaluated and thought about what the opportunity was at Pritzker. And if you step back, I eventually made the decision it was a once-in-a-career opportunity because here you had one of the most prestigious, admired families in the United States with a terrific brand that I didn't think was fully maximizing its brand. You had a couple of leaders who wanted to build a world-class business. This wasn't a hobby. They wanted to build a world-class business. They were fact-based. It was anything but whimsical investing. They weren't looking for trophy assets. They wanted to be fact-based and build great companies. They had a fabulous value system, upon which they had built a terrific culture. And the Pritzker's value system, honesty, integrity, loyalty, was inherent in everything they did. And they had built a strong culture around that in their operations. And they were liquid. So a lot of wealthy families aren't as liquid as that. Many wealthy families have their assets invested in illiquid assets. But here they had significant liquidity to go out and invest aggressively. And they had the benefit of family capital, which I think is inherently advantaged capital. So I stepped back and said, we can build something really special with all those capabilities and inherent opportunities. Now, they had a small middle market direct business that had done really some interesting deals, but many of the companies were subscale. They really weren't commensurate with their capital base. And I felt that we could bring discipline of system and procedure and tighten strategy and be more proactive in the marketplace about our family investing approach and leverage the Pritzker brand more aggressively. So I wrote a business plan. They accepted the business plan. I said yes. I left a firm of my mentor of almost 30 years, who had worked with at Kidder and at Baird.
That was Paul Purcell?
He was a special person. He was a terrific leader, and he led by his actions. He didn't sit in the ivory tower. He was out front, and he was a great mentor because he taught along the way. He would always say, Paul, you got to let your people execute. Let them grow and develop. Just so long as it's not a terminal mistake, let them go make mistakes. And so I learned a lot. I learned about how he thought about you've got to deal with the person, not just the employee. You've got to make sure you understand that the partner at home is as important as the partner who comes to the office, that you've got to deliver excellence. How you get to excellence is just as important as the result. So the journey is just as important as the destination. He operated through a very strict value system, which is honesty is the only way to go, and being candid with clients and direct. So he was terrific. So we were a terrific team, and he was one of the three that was with me when we went to Baird. He eventually became CEO. Steve Booth was the third. Steve followed Paul when Paul passed away as CEO of Baird. And he really helped set the culture and approach and strategy for Baird. One of the projects we did at Baird, for instance, together was when we joined Baird, I think it was something like, well, let me just put it this way. It was a majority owned by Northwestern Mutual, and the employees owned a minority of the business. And one of the projects we executed while we were at Baird together was buying the business back. So when Northwestern became a small minority owner and the employees became the owner of the business. And I remember multiple meetings over at Northwestern negotiating. And one meeting we left the Northwestern sort of behemoth corporate office, and then we were walking down the steps and they said, Paul, you're going to get fired, don't you? Because it was a very tough meeting with Northwestern, and Northwestern people are great, but they wanted to make sure we had a fair deal. And I said, there's a good chance you get fired tomorrow. He said, I know. But he took the risk. He did the right thing. It was the right thing for the firm. It was the right thing for Northwestern. And so we ended up buying back the business. That was one of the projects we worked on together. And he was a terrific guy. So he passed away in the early days of COVID. Not of COVID, he died of cancer, but he passed away, and I miss him dearly every day.
Did he get fired?
No, he did not get fired. No, he became a massively successful CEO for Baird and really led the firm into a terrific growth strategy across multiple businesses. And Baird today is a fabulous firm, in large part, I think, due to Paul and his vision. Now, clearly, he stood on the shoulders of giants. Fred Kasten was the prior CEO, and Fred was an unbelievable gentleman and banker and leader. Paul took what Fred had developed and took it to another level. I came to Pritzker after 18 years at Baird, 9 years at Kidder, and basically started the business. We reshuffled the team, we tightened strategy, developed tighter policies and procedures, developed an approach to how we focused on our family capital advantage in the marketplace and pointed that capital at users of capital who cared about what we could do differently with that capital. If we competed straight up with PE firms and we were buying a PE firm and they didn't care about our capital difference from other buyers, that was a waste of time. We were leaving our inherent advantage on the field. So we did a lot of sort of fine tuning. We built and scaled a team at the Pritzkers And it was just an unbelievable ride. And I had no clue we were going to raise third-party capital. In fact, I was excited that I could leave that behind, and I freed up what I estimated of 40% of my time. At Baird, we raised third-party capital, and I probably spent something on the order of a third plus of my time raising capital, managing outside capital, relationships, et cetera. And I thought, I've got another 35 to 40% of my time freed up. I can go do some interesting things on the investing side. So for the first 5-6 years, we deployed their capital only, the two brothers. And I think built a terrific firm, a special firm that is, I think, today one of the leading family capital investors in the middle market. But we were seeing more and more flow. We were out missionary selling that of others had done family investing, clearly. But we were a big advocate for the advantages of family capital and family investing and doing a lot of missionary selling. And so we were seeing more and more flow coming to us. Historically, when a family business or a founder wanted liquidity, wanted to partner, they had two options. They could sell to often their hated strategic competitor that they'd competed with for decades and watch their baby get consumed in the behemoth, or they could sell to traditional PE, and they might spend a lot of time picking a PE firm, and then 3 or 4 years later, PE firm sells to somebody else they have no clue who's going to be the owner. And those were the two options they basically had. And we brought to the table a third option, which is partner with somebody who's philosophically aligned, who understands the importance of culture and history and family pedigree. We understand the challenges of families because Pritzkers were a family, and we could build businesses, again, the right way and for the right duration. And that was a powerful message for the market. So we saw more and more flow from the market, and at the same time, we had other families knocking on the door saying that they weren't going to build a 50-person operation, and they wanted to partner with us. They wanted to see more co-invest. They wanted to see opportunities. And you stir all that together, the need for meaningful capital, as we were writing larger and larger checks. They were staying in the ground longer. They were compounding at high rates. So we were tilting the brothers' portfolio. And at the same time, we had others wanting to provide us capital. And so the efficient mechanic, we went through all sorts of analyses and assessment of what the right path forward was. We looked at evergreen structures. We looked at family club structures. We looked at all sorts of different structures. And we eventually settled on the one we executed and pulled the middle market group out of the family office, set it up separately as a side-by-side entity, still controlled by the Pritzkers, but we registered that entity. We didn't want to register the family office. So we pulled the entity out, registered that entity, and executed sort of strategy that we're executing today.
What was the family invested in outside of privates?
They had 3 groups again. They had a direct venture business. But JB has always had an interest in technology and venture investing. He had a business prior to Pritzker Group where he was a venture investor. And so there was a direct venture team making direct investments into young early stage companies. We had the Pritzker Group Private Capital. That was the middle market business. So the venture business, Pritzker Group Venture Capital, PGVC, and then the middle market business, PGPC. And then the third business was what we called PG Asset Management, Pritzker Group Asset Management. And that business was only the Pritzker capital, but it was a diversified pool investing in non-correlated, not necessarily non-correlated, but not venture, not private equity. So they did public equity, hedge funds, fixed income, et cetera. And it was mostly an outsourced model, picking the best managers in each category. And that, again, that was the piggy bank that we tapped into to execute the direct invest businesses, the other two businesses in Pritzker Group. Interestingly, no real estate. So people think about Pritzkers as being real estate investors as well. And these two family members were not interested in investing in real estate. And they had pretty thoughtful decision rules about where they would invest and where they wouldn't invest. So they had spent a lot of time thinking about their strategic plan. They had interviewed lots of family offices as they were setting up their business, their family office, their investing business. They really don't like to call it a family office, by the way. They like to call it as a family investment firm because sometimes family offices have connotations of slow, whimsical, not necessarily cutting edge. And we wanted to be world-class, cutting edge, top talent, executing top strategies and delivering top performance. And they didn't want any connotation of what another approach might be. So they had been very thoughtful, gathered lots of input, and executed and built this Pritzker Group entity to go deliver on those three strategies, and to the exclusion of lots of other asset classes where they decided not to invest.
What are the pros and cons of working with family members?
Families bring inherently a value system and a philosophy to the table. It's just who they are, how they operate, they do business. And that often is a massive advantage, because most of the families I know bring a philosophy and a value system that has it rhymes if it doesn't exactly overlap with honesty, integrity, loyalty. And so families often bring a value system you can build an attractive culture on top of. And when you build an attractive culture and you have the advantages of family capital, the inherent advantages, and we can talk more about that, you can attract great talent and you can go execute interesting strategies. And you can be flexible in how you invest. You're not constrained by traditional institutional capital and the constraints that they have to deal with. So working with a family, I think, has got massive advantage. Now, there's the disadvantages too. One source of capital. Do they have necessarily all the tools and capabilities of a much bigger firm? Maybe not. Do they execute always with the speed and certainty that you need in a massively competitive marketplace? Not always. But I've found working with them to be absolutely fabulous. I've really enjoyed the partnership with the family, and what they brought to the table was a great compliment to what I think the investment team and operations team that we brought to the table. It was a terrific, and has been a terrific partnership to this day.
What was the rationale for separating the private equity function and making it a freestanding company? Why not just keep it all in-house if they were doing very well?
We had been out missionary selling the advantages of our kind of capital, and we were seeing a meaningful flow of opportunities. And over the years, we're seeing bigger opportunities requiring bigger checks. They were staying in the ground because inherently with family capital, we could have whatever duration we wanted. So they stayed in the ground a longer period of time, and they were compounding at high rates. As you did forecast models, this was not sustainable because they have their very wealthy people, but they don't have unlimited amounts of capital. And at the same time, again, we'd seen people knocking on our door, families and others who wanted to partner. And there was an investment opportunity we looked at that really was the tipping point. It was a company that we had developed an exclusive dialogue with, and we negotiated an exclusive deal. It required something on the order of $600 million of equity to execute. And what we had decided is the prudent amount of capital that we wanted to put on the table was $300 million. So we had to go out and raise $300 million. We had never gone outside to raise third-party capital on a deal-by-deal basis, let alone on a more structured basis. We decided to go bring in partners for the first time because this was a great deal, we thought. And so we said, we'll go bring in 6 families, $50 million each, and we'll go close the deal. And I think we had something like a 45-day exclusive. But we nearly killed the team because we had to go due diligence, a $1 billion plus deal. We had to go raise significant debt, and we had to go raise $300 million of equity and get it all closed in a discrete period of time. And the process to go past the hat with other families was ridiculously inefficient. And we thought we'd go to 6, maybe 8 families. We ended up going to 20 plus. And it was just inefficient. And it was inconsistent with speed and certainty, which is often required when you're doing a $1 billion plus deal. We got the deal done. We raised the capital. We stepped back and said, we've got to think about a different approach. This is not repeatable. You can't build a systematic process around this sort of approach. And that's when we evaluated all sorts of different avenues for how do we bring in partner capital that doesn't undermine what brought us to the dance. What brought us our competitive advantage was the flexible, longer-term family capital. And so we said, how do we take full advantage of the opportunities we were getting, and which led us to we needed to bring in and wanted to bring in partners. Then the question is, how do you structure it so that it doesn't undermine your core thesis of your strategy? And then how do you do it so the family continues to have the ethos of a family investment firm? So we looked at multiple different paths, and we decided the one that we did. And one of the reasons, for instance, we looked at sort of an evergreen structure where we thought, well, families have a longer duration. We could build an evergreen structure that obviously exists in the market today. But what we found was there were just meaningful impediments. We would go sit down with the family and talk about an evergreen structure, and we'd spend half the meeting talking about a liquidity mechanic, as opposed to how do we both go and buy and build great companies. Permanent capital provider was spending a lot of time talking about how do I get my money back. And so what we decided to do is let's show the market something they're used to seeing. Let's not try to build something outside sort of the comfort zone of families. And they're used to seeing GPLP structures. But we said we can't give up on the one vector that was critically important, and that was duration flexibility. So we ended up structuring a longer duration vehicle that also had familiar sort of terms and provisions in it that the family could get comfortable with. And we pulled it out because if you raise third-party capital and you want to get paid on that capital, you have to register. And we didn't want to register the family investment firm, Pritzker Group, because then you'd open up to government regulation all the aspects of the business. There's only one business that we needed really to think about third-party capital, and that was Pritzker Group Private Capital, which eventually became Pritzker Private Capital. And so that was the business we wanted to register, which would allow us to bring in third-party capital and get paid on that capital. So that's why we pulled it out and registered it.
Now, did you have the challenge of having to build out a back and middle office at that point too?
Excellent point. Excellent point. So we had shared the back office with the other businesses within Pritzker Group. In order to be standalone and be separate and have a true Chinese wall between the family office, family investment firm, and the new entity, Pritzker Private Capital, we needed to be self-sufficient. So we had to quickly build a full back office. At the same time, we were going out in the marketplace, talking about this new entity and talking with new partners who might join us. That's why I say this was along this whole journey. There was no grass growing under anybody's feet. We were running hard the whole time. And this was one key element of the journey that set the stage for the next phase of growth for the Pritzkers and our investing business. But you had to scramble to get it all organized up front. And we've got a terrific sort of operations support group. And many of the people that we brought on in those early days are still with us.
What sort of surprises were there when you ventured out of the safe family harbor and things that you didn't expect?
Yeah, it's a good question because I was, and I think a number of people on our team were deathly afraid that by going out with a structure that looked like traditional private equity, that we would be seen as traditional private equity. And we competed with traditional private equity. We offered a different solution to our target market. And if we're perceived to be the same as our competition, then we had a problem and we'd undermine sort of our strategic advantage. And so we were concerned. And in fact, when we came out with the structure and the new approach, we had some families, I remember getting a call and saying, "It's too bad, Paul, you went to the dark side." And that's always stuck with me. But here's the reality of what happened. We were concerned that our family credentials and credibility would be impacted. And we were right. It was impacted, but it was impacted in a positive way. I had never expected this outcome. We received positive feedback from the market that underscored our differentiation, that we were still seen as a family investment firm. We still operated the way we'd always operated. We had Pritzker pedigree and history and philosophy, but having publicly known, established, committed capital from multiple sources gave us credibility with the market, with investment bankers, with sellers, that we were real, substantial, and had a stamp of approval, that the market had said, yes, we want to support this strategy. Multiple terrific families supported us as limited partners. We had hired at the time, we thought, the premier placement agent, Credit Suisse. We had their stamp of approval. In fact, our credibility was enhanced by doing this strategy without diminishing fundamentally what made us different and special, the family pedigree, family capital. So we were fortunate enough to find that path that allowed us to continue to grow, source capital, execute, but still preserve the benefits of our strategy and the opportunity we had created in the marketplace.
So patient capital or family capital is a particular mindset for managing family office portfolios, but I'm curious what actual competitive advantage it might give you in the marketplace when you're up against these very aggressive firms.
There's a couple of things I want to comment on. One is I don't like the term patient capital. There is nothing PPC does that's patient. We push all our chips on the table every day. We expect to create value every day. We expect people to build, to grow, to develop, to execute in a flawless way. There's nothing patient about that. What family capital gives is ultimately flexibility. You have the flexibility, again, to build companies the right way. And I'll give you some examples. but build companies the right way, for the right reasons, for the right duration. So you don't want to hold a business necessarily forever. You want to hold the right businesses for a long time because of the power of compounding. So we always had a philosophy of we would re-underwrite our companies basically every year. And we would, if we could see a path to continue attractive returns, we would be biased long. If we saw those returns at risk, technological changes, geopolitical changes, customer changes, and we saw that potentially the return profile was going to slope down, we might be biased short. And at any point in time, we were always open to somebody knocking on our door and paying us full and fair value for a business. So it was the flexibility of doing the right thing at the right time, which I think is the essence. It's not that it's just long-term, but it's flexibility. And let me give you an example. The other thing that differs is how you build businesses. If you've got capital that isn't necessarily constrained by a very strict timeline business model, how you think about investing in the business, how you think about developing talent, how you think about investing in technology, how you think about your growth strategies is different than if you're thinking that you've got a 3 to 4 to 5 year time horizon. Is you've got a 5-year time horizon, let's say, you've got to, in the first 18 months, you got to make all your changes. The next 18 months, you've got to see those changes come through the income statement. And then you need a year to go exit the opportunity. So you'll make different decisions. So the analogy we sometimes use is think about the position on a mountain. If you have 3 buyout firms that own the same company, each for 5 years, and then you have a family that owns the business for 15 years continuously. And at each point on and it's the same firm, let's say, with the PE strategy, the buyout strategy, every 5 years, there's going to be a change in ownership. There's going to be management steps back, tries to find a new partner. It slows the business. You've got friction costs, transaction costs. You're impacting the business, whether you like it or not. And that happens 3 times during the 15 years. And they compare that with a family ownership over continuous 15-year ownership. No friction costs, no transaction costs, no slowing the boat because the management takes their eye off the console. You can end up at a higher point on the mountain with the family capital because of the way you invest, how you invest, and the other differences I've outlined, the 2 comparisons. I think how you build a business can be different. And I think you can end up with a better company because of the characteristics of family capital and what you do with that capital.
How is what you're doing different from club deals?
Club deals is a variation on the theme of pass the hat that we talked about. And I'm not saying that's the wrong approach. It's a more difficult execution when you're dealing in scale where speed and certainty is a requirement. Our capital's advantage, but $1 billion family business seller is not going to wait around forever. They've got expectations, they've got options. And so you're going to have to work with some timeline. And especially as you get larger deals, the pass the hat, the club deal structure creates inefficiencies. You've got multiple decision makers in pooling that capital. And at the end of the day, you still need I still think you need one sort of leader to make sure it all happens. And then post-closing, that leader has to make sure that the business executes and has the resources it needs to go fulfill on the objective you set in your investment. So club investing is certainly a mechanic and a methodology that works. And it's been around for a long time. Obviously, families done club investing forever. But it's technology that isn't necessarily optimized along the continuum of a maturity curve or size of a company and isn't necessarily optimized for certain points in the market. This market is massively overcapitalized. There's lots of capital chasing opportunities. And sometimes those long-term models like club deals or pass the hat sometimes get disadvantaged because of how they execute and the timeline it takes to execute.
How do you get alignment from your co-investors?
Because we sit down and talk with them. They do due diligence on us. They try to understand who we are, how we execute. And families have lots of different options and places to put their capital. And they choose us because they've done their work. They think we're talented investors. They've done their due diligence on us. They understand that how we build businesses, how we source fits with what they're looking for. And so they've done due diligence on us before they commit to our pool. And then we go and execute. But there's a lot of work that's done at the front end to making sure there's alignment, there's like-minded approaches both ways. So expectations for return, expectations for timelines. So there has to be an alignment and there has to be, it's an overused phrase, but like-minded both ways. And so we all basically decide to get married at the front end and then we go execute and go and deploy, build companies and hopefully create return.
Who isn't a good fit for that?
A couple examples would be investors that have a higher velocity expectation on their capital. They want to deploy and see that capital back faster. Faster is relative, but so investors who have high velocity expectations on their capital, higher velocity than maybe norm, may or may not be a good fit. The other one is investors who aren't comfortable holding assets longer or for a longer duration partnership would be, and some of those you can think about. Some fund of funds have very limited durations as well, and they can't have certain vehicles in the partnership that extend for a longer period. So it's the investors that have to think hard about us would be higher velocity expectations, and investors who require a shorter duration hold.
Do your metrics for success differ from other private equity firms, and maybe have those metrics changed over time for you?
No, I don't think the metrics differ. We want to sweat our equity. We take risk as an investor, like every investor takes. People say, oh, the families, they should be comfortable with X hundred basis points above treasuries. No, that's a mismatch between risk and return. And yes, we can hold assets longer to make the money multiple better. But what will end up happening is your IRR, how you get paid every day, is impacted materially. And we want to get paid both on IRR and push the chips on the table like we expect return, and at the end of an investment, the money multiple. So we don't think you try to make up for a crappy IRR by holding an asset longer. That you basically you've got money that's not returning appropriate amounts for the risk you're taking, because you're taking risk. And our capital's taking risk just like traditional PE. So we expect to be compensated for that risk. Now, one of the things we can do, we can work with a management team and say, you know what, we don't have to have consistent IRR because our timeline might be different. So we can say, let's invest in the business in the first 2 years. Let's take EBITDA down. Let's not actually create IRR in the near term, because we expect our IRR to be much better years 3 through X, because we've taken the time to invest in the business, build the foundation, hire the right team, et cetera. So we can make those decisions, balancing out current return for future return. But at the end of the day, that investment has to generate an attractive return relative to the risk we're taking. Otherwise, we should take the capital and put it somewhere else. So family capital isn't inherently lower returning capital because of the duration. I think that's the wrong way to think about it. Family capital is flexible capital, but I think families should be rewarded for the risk they take just like any other investor.
Maybe we could talk a little bit about a specific deal. What can you tell us about C.H. Gunther?
C.H. Gunther is a multi-generation, family-owned bakery. It's one of the largest privately owned businesses in Texas. It's been around basically since the time of the Alamo, and multi-generations of family has owned the business. And they were in that conundrum of family members, each generation of family members, more and more family members who were expecting dividends out of the business, more and more complexity given the number of family members. And I think the total was some 170 family members who had investments in the business at the time we had the discussion. And the family was receiving dividends out of the company, and it was a major asset for the family. And they basically made the decision that potentially the best thing for the company and the family was to bring in a new partner and let the family go distribute the capital out to the family members and let them do what they wanted to do with the capital, and allow the company to bring in capital to facilitate growth. So when you have a dividend strategy, sometimes you're pulling capital out of the business. Sometimes there's good uses of that capital in the business. And so there was potential constraints on the company, but it wasn't necessarily optimizing sort of the family's asset. So it was primarily illiquid. So the family basically said, we should think about finding a partner. And they were stuck because they had that traditional two-path option. Go sell to another major bakery and watch their family business be dismantled or consumed. Or sell to traditional PE, watch the business get levered up and then flipped in 3 or 4 years. And so they were stuck. They didn't want to be that generation that created a fundamental change in the business. And so we were introduced to them through another business that we had owned in the food packaging space, and basically developed a dialogue. And over many months and multiple quarters, developed a dialogue and basically created that third solution, third path for the family, where We were not going to own the business forever. We're very candid with people. We talk about owning the business for the right duration, but we're going to likely own it longer than the traditional PE. And we understand family dynamics. We will, I think, be good stewards. We will honor legacy, honor culture, honor what brought the family the success they had, make the family proud of the next chapter that we were going to write. And so we could do things differently, and the expectations on us were different. For instance, here's another example. They had a restaurant business, losing money. This was a major tourist attraction in San Antonio. They wanted to keep the restaurant in existence. Most traditional PE would shut down the money-losing operation. What is a bakery doing in the restaurant business? But the family wanted us to keep that business going, and we did. Many companies have major sort of philanthropic programs, community support programs. We often not only support those programs, but encourage further community involvement and philanthropy out of the company. So we'll do those sorts of things. We'll build a tech center and help companies build something that doesn't have a current return on it, but for the long term allows the company to advance its customer relationships and product development capability. So they picked us as the partner, and we closed the transaction, and I think we fulfilled on what we had promised the family. And interestingly, we offer our family sellers the opportunity to roll into the new deal with us. But here with 170 family members, it was hard for them to get together and figure out how much people could roll and who was going to roll and who was not. And so basically the family decided no one got to roll into the new deal. And so it's a bit different than our other family businesses that we've partnered with, but there were no rolls from the family, rollover of equity. So we brought something different to the table. It was a sizable $1 billion plus transaction. We addressed the family's needs in a different way than other capital, and we still own the business today after several years later. It's a terrific example of, I think, how family capital can address the needs of sellers differently than traditional institutional capital.
What was your original diligence like, and what concerns did you have about the business itself when you went in?
Yeah. So interestingly, there were no family members really were in the senior management of the business. So we always evaluate management and the ability of a core group of managers to sustain the growth and take the business to the next level. So we found a terrific CEO and management team. But you wonder, when there's family taking dividends out, how much deferred capital has been left on the table? How much incremental capital would we have to put into the business to support the business? So that's a question you want to think about when the business is basically helping finance the family's lifestyle. What two is, you've got to look at always these businesses, you look at customer concentration. And so that was a question we had with the business. And then you have the other questions of, what's the value creation strategy? How do we build on the success that the family had with this business and fundamentally change the trajectory of the business? So by just doing what they've always done gives you a return. But we like to try to change the trajectory of the business and create an outsized return based upon our efforts and building off what the family had done previously. So the question then becomes, what's the strategy? And one of the core elements of the strategy was something they had a hard time executing. They had done it, but they hadn't optimized on it, because strategy that we pursue was not only organic growth with existing and new customers, but to ramp up the add-on acquisition strategy. Now, they had done that under the family ownership, but it became increasingly difficult because they were taking that capital out of the business. So we could bring it to the table, an inorganic growth strategy that could amplify what they were doing, and as a result, grow the company faster, bring it into new markets, bring in new products through acquisition, new talent, and build the business in a more diversified way. It's a lumpy step function capital deployment. And when you build a bakery, it's not an insignificant cost. We could bring meaningful capital to the table to help with the step function growth of the business's capital requirement. And we help the business grow internationally as well. They had done international growth, but we then helped amplify it and grow it beyond. So you look for who's going to execute the strategy. What's it going to take to execute the strategy? Does the strategy need to be modified, enhanced? And then how do we do all that to fundamentally, with some reasonable certainty, change the trajectory of the business? And that's a typical sort of approach and review of opportunities.
And how did that play out over the years?
The company's been a great success. And I don't want to use numbers, but we've helped build the business alongside management. Obviously, management's taking point and executing. We try to say, we pull on the oar with management. We bring resources, capabilities, opportunities, access to help the companies execute, but the management teams execute. We don't run companies. But we've executed on the strategy, and the strategy has been executed the way we want. It's not a straight line, never is. COVID gave us a chink in our growth, but the business is executed well, and I think the family's proud of what the company's become.
How do family-backed investors think about exits?
Yeah, you can't paint with too broad a brush here. It's a function of what the family's goals and objectives are. And what we've seen is generational transition creates that inflection point where families have to face certain decisions. And so often you see either families preparing for a generational transition or are dealing with a transition that requires action. So I think that's one of the things that family-held businesses are different than institutional businesses. The generational transition isn't always anticipated, planned for, and becomes a challenge for many families when they go through that, because you've got all sorts of needs and different expectations. You've got assets that may or may not be generating the kind of return or liquidity. You've got a new direction, new strategies being implemented by the next gen. So that's one difference, which is I think there are natural inflection points with the family during these generational transitions that I think are often an impetus for change that you don't necessarily have with an institutional business.
So some families can naturally take advantage of this, but it's not for everyone. Are there other pathways to private markets?
So if you think about family capital as being advantaged, and it's advantaged because of it's permanent and proprietary, which gives flexibility. And then it's also advantaged because it's imbued with an ethos. So permanent proprietary with an ethos, that together allows families to do different things. And when those differences are pointed at markets and sellers that care about those differences, you can create advantage. It's inherently advantaged capital, but there's relatively few families that can or should try to be a direct investor. If you can execute well as a direct family investor, you have the opportunity to generate premium returns because of your advantage capital. But I often talk about families have to have sufficient capital, sufficient timeline. They have to have the value chain optimized, starting with family values and objectives at the core. You have to match a strategy to those values with defined objectives. Then you have to match a team that's incentivized and aligned that can execute that strategy. And then the team has to execute tactics, process, procedures, disciplines, and then they have to go execute. And that value chain has to be in alignment or you've got a problem as a direct investor. And again, the overlay is you've got enough scale, you've got the timeline, you really need to have a public profile. That's a difficult value proposition. It sounds easy, but it's a difficult ask. And most families shouldn't try to take the core of their assets and be direct investors. Now, I'm not saying that all families shouldn't have some direct invest activity. I think they probably should. But if you're talking about the core of the activity, that's a path that's not easy. So if you say that's only for a certain number of families, certain percentage of families, your question, how do the rest of the families access the private markets? So I would put a proposition out that the alternatives, the private markets, generally outperform the public markets over long periods of time. So if you want real alpha in today's world, you got to have exposure to the alternatives market. And if you can't be a direct investor, then you've got to figure out how do you access partners who do it, who are direct investors, and how do you build a diversified, disciplined portfolio of partners who can execute for you. And then you can either build a team inside your operation to go find the best managers doing X, Y, and Z in the private equity world and build a diversified portfolio, and then take advantage of co-invest and other things the managers present to their partners. But even some families, that still require talent, a team. You have to have the right alignment and incentive. So there's a gradation of sort of access. Direct investor, you develop an internal team to go execute and find the best managers who are at the coal phase. And then one step below that is you go outsource your capital to somebody who can pick the managers to deploy the capital. And so there's gradations of approaches to the private markets that has to fit the company, the family, what they want to accomplish, what they want to tolerate, the risk reward they want. But there's options out there for families to access the private markets, and they've got to figure out where along that continuum they want to play and where they feel comfortable.
There's a big movement to democratize alternatives. What do you think the private equity market looks like when these potentially trillions of dollars come into the space?
Yeah, it depends on what sort of investor. When people talk about democratizing investors, it depends on the investor base. And clearly, this is an illiquid class that doesn't generate a lot of return of capital consistently or in the near term. And there's volatility to the class. Now, investors should be rewarded for that illiquidity and volatility, but you have to still tolerate the illiquidity. And so what I worry about is when PE firms step down from the massively wealthy to the ultra wealthy to mass affluent to an investor that might have some excess capital and wants to put it to work in the private markets. What I worry about is the sophistication of the investor. Does the investor understand the risks that he or she is taking? And can they tolerate the illiquidity and the capital lockup and the volatility, potential volatility? And I worry that investors, maybe as you go down that continuum, don't fully appreciate the risks they're taking and don't necessarily appreciate that the liquidity that they actually do need in their lives. And so I worry, and I've dealt with this when I was at prior firms where investors would call me and say, "Where's my dividend check?" And I said, "It doesn't work that way." So I just worry that some investors will get into this asset class and not fully be prepared for what it means.
What advice do you have for families getting into directs and setting up a team?
I think it's critical before you start talking about recruiting a team is link that with a strategy. How do you want to access the market? How do you want to deploy your capital in the private markets? Because I think it's critically important you set the basic tenets of your strategy before you hire the team. Because if you do it in reverse order, if you hire the team first, the team will set your strategy. And that may or may not sync up with your values and objectives and may not sync up with what you want to accomplish. So it's values and goals, basic strategic tenets, attract a team. And then the team, once you have the team, you set up disciplines, tactics, processes, procedures to go deploy, and then it's execute. It's the consistency of that deployment, that alignment across all of that is critical. And any big kink in that sort of alignment could create meaningful issue. So to your question about how do you attract a team, I think you've got to show the elements of all of that. I think people want to work for people who have strong cultures, strong values. So you have to attract them on that basis. And that's in part how you retain them as well. But having a culture and a value system, I think, and making that explicit in terms of how you think about attracting a team. Second is making sure the team understands the sustainability of the strategies. This is where I think a lot of families fall off on their strategies, which is recognize this is a long-term game. Capital adequacy and sufficiency is absolutely important. And the team has to understand this is not just a 2-year effort, but attracting the right team requires an understanding that this is a sustainable long-term strategy and proving that out, demonstrating that to a potential team. And then third is what sort of autonomy, governance, oversight are you going to put in place that empowers a team? You want to make sure there's guardrails and systems to protect the family, but people inherently want autonomy and ability to go develop and execute. Once they've developed trust with the family, once they understand the rules of the tenets of the strategy, they understand the objectives and how those objectives are accomplished, the team is going to want some autonomy. So you've got to figure out a governance system. And then you need the incentive, the economic incentive piece of the puzzle. And that's not just capital. When I first moved from institutional capital to family capital, one of the biggest selling points beyond values and culture and sustainability of the enterprise was the fact that I wouldn't have to go fundraise. And I could pick up 40% of my time and apply it to what I love to do, which is invest. So it's creating an opportunity set for talented executives to create reward, to be compensated for return, but also recognizing that the other things are of value to them, like not having to fundraise, like working with the family in support of both their commercial and philanthropic objectives. All of that gets stirred together in terms of incentives for attracting a team. And then providing a development and growth plan for the mid and junior level team. All of that has to come with it. But all of those pieces of the puzzle have to be thought out and implemented to attract and retain a great team, because these people have options. And I know that when I first came to the Pritzkers, they were very clear. We want top returns. To get top returns, we have to have top talent. To have top talent, we have to pay market compensation. And that's both a base bonus and an incentive program structured to make it simpatico with the family's objectives and the family's approach. It doesn't have to absolutely mimic PE, but it has to be a shared upside for rewarding performance. And I think that's critical. And a lot of families forget the incentive piece and just assume a base or bonus makes sense. But talented people have options, and you want to make sure you compensate them and share upside and share downside.
What do you think are rookie mistakes families make when they get into this space, when they get into directs?
I think there's a whole slew of issues. One is not fully and clearly laying out that whole value creation ecosystem, that line, not fully understanding why they're doing this, for what duration, with what acceptance of risk, for what return, with what strategy. So if they've not done the foundational work, I think they're building sort of something that has a higher probability of going off kilter. The other rookie mistakes is not fully appreciating the timeline. This is as we said before, this is a long cycle business. And the probabilities of deployment, people underestimate how difficult it is. We've talked in the past, this is a less than a 1% business. You have to look at 100, 125, 150 opportunities to find one that works. And then you find one, then you have to negotiate it, due diligence it, and find the right price that works from a risk return point of view. And then once you close, you got to go create value. And then the world changes on you and you have difficulty in executing your plan. Then you have to throw more resources at it. So I think it looks easy, but I think families make a mistake that they don't understand the complexity, the competitive dynamics, the timelines. And then they get mixed up with what are they trying to accomplish. A lot of families talk about, I want to be opportunistic in the market. I want to look at the best opportunities. And what that just says to me is they've not thought clearly about where their competitive advantage is, where they can create value, what their right to win is. How do they compete against these top tier institutional investors and win and then create value once you win? I'm dubious of opportunistic investing, but create the team, the strategy, the alignment, the capabilities to go win in a market and then create value with those opportunities. Hiring the wrong team, rookie mistake. Not incentivizing the team correctly, not hiring the right team to execute the right strategy that's right for the family, not just the team. We've seen that running out of cash. This is not a game where you just deploy and stop, because teams want to go deploy and you're going to lose your team. Not being willing to have the public profile. The way you source opportunities is you communicate to the marketplace what you're interested in and why you're the right buyer for certain assets. That means you have to take a public profile. And if you're not willing to take the public profile, you're going to narrow your funnel of opportunities and you're going to sub-optimize on the opportunities. The other thing is I hear from firms, I want to only look at opportunities that I can drive to from my office. When the top of the funnel is constrained, the bottom is sub-optimized. And so all of those sorts of things in various iterations with families who want to explore direct investing, and all of those could create issue over time and sub-optimized returns.
Now that you're vice chair at PPC, have you thought about ways to preserve the knowledge you've developed and share it more widely?
Yeah, listen, I think this is a terrific asset class. I enjoy working with and talking with families, and I'm a firm believer in the inherent advantages of family capital. And one of the things I've done, I've got multiple projects, but one of the ones that I'm most excited about is the University of Chicago Booth School has launched with support from me and others in the family world, the Family Office Initiative. And it's a program designed to target and serve current and future leaders of family offices. Now, there are quite a few family academic centers that focus on family business. There's relatively few major academic centers that focus on family offices. And family offices are quite distinct from family businesses. And so I'm very excited to be involved with what Booth is doing to build a program of differentiation and distinction targeting family offices. And we've made terrific progress so far in terms of attracting the interest of many preeminent family office leaders. We're launching an MBA course here in the winter. We're building out network, a family office council. And then next year, we're going to sponsor our inaugural family office summit for 150, 200 people, family office leaders from around the world. We're building, I think, a program that sits on top of an academic center that can dip into the intellectual capital of an academic center and do it in a non-biased, non-commercial way to address the needs, the interests of family office leaders solely. And I'm excited about what they're doing, and we're getting terrific feedback from the marketplace that there's room for Booth to go execute on this strategy. And I think the family office world is excited about it.
Paul Carbone, thank you so much for joining us and sharing your insights today.
Thank you very much. It was fun. I appreciate it.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.